They want to be able to qualify for credit for that specific purchase, not just put on the credit card. If you carry forward a balance on your credit card, you might have bought a tuna sandwich for lunch, and you also bought a television. And if you can't pay the full amount at the end of the month, you're going to start accumulating interest, and you don't know what you're paying interest on. Are you paying on the TV or are you paying on the sandwich? The sandwich might be digested a long time ago, but you're still paying for that sandwich carrying forward on your credit card. So people enjoy the buy now, pay later process because it's a specific loan for a specific product. They know when they buy it, they know when they finish paying for it, right? So it really isolate that purchase and the interest being paid on it.
Hello, ladies and gentlemen, and welcome to our interview with Stephane Touboul. Stephane is the founder and CEO at WeGetFinancing, and he is a seasoned entrepreneur with over 25 years of experience in the online payment and credit industry. As the founder and CEO of WeGetFinancing, he is transforming the point-of-sale financing landscape by offering innovative solutions that connect merchants with a broad network of lenders. Stephane, welcome to our Risk Management Show podcast today.
Thank you, Boris, for having me. Pleasure being
Absolutely,
here.
it's my pleasure. So, Stephane, I believe that we will have a very thoughtful conversation on the topic of risk management and fraud detection in a consumer credit space, and especially building trust and flexibility in the BNPL or buy now, pay later space, that is very popular right now. But before that, could you tell us a short story about yourself, your career path, and what brought you to where you are right now, perhaps, and what you guys at WeGetFinancing are up to these days?
Sure. So my background originally was in telecom. We had a international telephone company that was both in Europe, Middle East, and the United States. And from there, I built a company that called Telecom Billing System, where we use the telecom billing network to allow consumers to make purchases online in the early days of the internet before broadband. So we use telephone connection through dialers to actually identify the consumers and allow them to make those purchases and charge them to their phone bill. As technology has grown and developed and more into broadband, we started developing state-of-the-art patented technology to very precisely identify consumers outside of their phone bill, clearly, and solely using first name, last 4 digit of SSN, social security number. And along the way, we had to clearly identify fraud and build systems within our platform that captures fraud from the get-go in order to guarantee that the people who are actually making that purchase or attempting to make a purchase or borrowing money on that in that transaction were who they said they were, located where they were supposed to be located. And it was just not identifying the consumer, but also identifying the device that they were using, making sure that that device belonged to them through a network that we could recognize. So the technology has been built over many years. We are a thriving company. We've issued hundreds of millions of dollars in loans to consumers making purchases both at online and brick and mortar locations. And we have a large network of lenders who are participating with us, who trust us not only to bring them leads of consumers that want to make a purchase and borrow money from them, but they know that when we bring those transactions to them, they are pretty much fraud-free. We built so many systems inside of the system to filter out bad players that lenders are eager to participate in our network. And interestingly, the portfolio that they create with us perform much better than the ones that they create on their own because of the identity verification and fraud detection that's built into our platform prior to referring a borrower to the lender. So that's, at 10,000 feet, that's pretty much a bit of the background of the journey. And that's where
Mm.
we are today.
Is Klarna kind of in your space? Because in Europe we know about this Klarna in the space, right?
Yes, Klarna is indeed a player in the US. Now, we are a US-based company, and we service the US consumers and lenders that who are able to lend to US consumers. So the market is big enough that there's no need for us right now to look outside. Maybe perhaps Canada is an option later on, but we're not a player in Europe.
Mhm.
Uh,
Okay.
Klarna is a Swedish company. This is where they started. This is really their turf, and they have been in the US probably almost 10 years now. And we've met with them. We know who they are, but the business model is a little different from ours.
Interesting. So let's understand this a risk involved in the BNPL space. What are the key risks and how do they differ from traditional consumer credit products?
So the buy now pay later option, which is become extremely popular, a lot is due to the fact that the convenience of it, but also the amount of credit card debt that U.S. consumers find themselves into right now, where credit is not always available, or they don't have the ability to pay off a large purchase at the end of the month on the credit card. And in case of a revolving line of credit, that means that interest is being charged carrying forward those balances. And because the interest are compounded daily, even though the credit card might say it's at 19% or 24% interest, because it is compounded daily, turns into easily 40 or 50% interest at the end of the year. So a consumer find a buy now pay later offer with a single digit APR, let's say, average percentage rate, even much more advantageous over 12-month, 24-month, 36-month, gives them the ability to pay it over a longer period of time and to know ahead of time what the interest rate will be throughout the loan. Also allows for larger ticket purchases, which is hard for sometimes consumers to make with a credit card. So the risk factor comes from the fact that specifically in specific verticals, such as what we call high risk, or let's say a piece of jewelry, if somebody wants to buy jewelry, they want to steal somebody else's identity. In order to do so, they receive the merchandise. It can be monetized in the street very quickly, even at 50 cents on the dollar, because it's a large ticket item. They could attract thieves to try to steal other people's identity to make a purchase under their names and their credit. So we've built a system whereby not only have we have a process where we can identify that the consumer has a specific cell phone number. So we'll send them an SMS with a code. So they must have that cell number. We also know who's the carrier of that cell number, right? So for instance, a big difference between a prepaid cell phone and a postpaid cell phone, meaning that somebody who has an account with AT&T, let's say, must have a certain credit level to qualify for the monthly payments, if you want. They use the phone. At the end of the month, they receive the bill and they have to pay for it. It's what we call a postpaid, right? So if it's somebody that just want to get a burner, a quick cell phone at the local store, that's already an indication to us that the credit cannot be that great, right? If it's a postpaid phone, then we know that they qualify for credit by the carrier. That's the first part. And when we send them an SMS, we know that they have received that the person's identity was given at the time of the application for credit, has received through a phone that's affiliated with them the proper SMS, enters it on the screen, and that gives us one layer of verification. There's many other layers of verification, meaning that we are connected to a multitude of reputable databases I don't know if you're familiar in the States of a company like LexisNexis or DataX, and they'll verify that the information provided actually correlates. So, meaning that the first name and last name and address, a phone number, a zip code, are those all located, all connected to one another. But somebody who steals somebody's identity might have this information. They might not have the phone number. They might not be able to receive the SMS, but they still will be able to answer some of those questions. But what we'll do is that we'll also geolocate the consumer, making sure that they are within a certain mileage or radius of where they're supposed to be located. So if it's a transaction that comes with an IP address from a foreign country, let's say, or a different state, or a state that's not affiliated on the customer's credit report of where they have a residence or have a place of work, then you raise this red flag, right? Raising red flags means that we are able to pull a credit report on the consumer, unlike in Europe. Some that doesn't exist, but here we get a credit report with what we call a FICO score. So based on that FICO score, we know what their credit quality is, but you also have history of credit, and we have a lot of information about the consumer. So at that point, if there are some red flags, and this is an internal point system that we've created based on different events. If we get to a certain point level, then we're going to start asking knowledge-based questions, meaning that, okay, so we see that this person is leasing a Toyota. Right? So we say, you currently own or lease a car, right? They have to answer that question. See, if I'm leasing, okay, that's the right answer. You're currently leasing a Volvo, a Toyota, or a Cadillac, and they have to answer these questions. You own a house and your mortgage is with Bank of America, Chase Manhattan, or some other bank, right? So they need to answer. So there's what we call knowledge-based questioning. So we verify further, that this person has intimate knowledge of being the applicant. Only the applicant will know those answers. You reside at this address and your previous address was this address. And we give, 2 or 3 different addresses and need to pick the right one. So as it's not always the same process, but as an application comes in and based on the consumer behavior and what we observe in terms of the way the customer is handling the transaction, there are systems that get into place and processes that further verify the identity of the consumer. Thanks to this system, we've been able to really almost completely eliminate fraud. And because of that, our lenders want to participate on our platform. So in the fintech industry, if you want, right, the buy now pay later business, most lenders are financial technology firms. They're not really banks. They borrow money from private equity, and they have money on the balance sheet, and the spread is what they lend the money for, and the borrowing rate, right? This is how it works. But really, the lending business belongs to the banks. The banks are the ones who borrow from the feds and able to offer much more attractive interest rates to the consumer than a fintech company. Now, the barrier to entry for banks to offer buy now pay later to a consumer making a purchase online is their ability to have the technology to integrate what we call shopping carts. So a merchant who works with Shopify, right? The whole entire shopping cart is administered through Shopify, but XYZ bank might not have the technology to be integrated into Shopify. Therefore, a participating merchant on Shopify will never be able to offer credit to their customers through that bank. With WeGetFinancing, because we have the integration into all the different shopping carts, Magento, Shopify, BigCommerce, and so on and so forth, now merchants are able to offer credit to their customers through traditional banks who have lower and more attractive interest rate than a typical fintech. So what WeGetFinancing does is that we bridge, if you want, this technology barrier for the banks to be able to participate in a marketplace where their credit can be offered to consumers shopping online or shopping at brick and mortar stores.
Mhm.
So, so clearly the risk management piece of our business was extremely important, and we've spent, I mean, a large amount of resources, both in time and in funds, to make sure that we have a state-of-the-art fraud detection system that's constantly being updated and constantly tweaked, so that we can optimize the use of the technology and offer very attractive credit to consumers, both online and brick and mortar stores, not just in a bank. They don't need to go to the bank, apply for a personal loan to purchase the appliances, or to purchase a piece of jewelry or furniture and so on and so forth, right? Does it make sense?
Yeah, absolutely. So you described how you detect fraud challenges and deal with this, and also probably identity verification, KYC measures. Can you explain the technology behind this? What perhaps AI, machine learning, that recent trends you also implement in your technology, right?
Excellent. So this is a wonderful question, because no, we've been doing this before AI became like really the buzz, sexy words, if you want. So what we encourage our lenders to do is to send back to us what we call negative data. So if there's a consumer, let's say that we have less than 1% fraud, but if there is fraud, if there was a case where somebody's Peter Smith's junior and Peter Smith's senior live in the same house, right? So they have the same address and the same zip code, and they might have the similar last four digit of social security number, or the junior knows senior's last four digit social, right? So this is called friendly fraud. We could run into a fraudulent situation where the IP address is correct, the physical address is correct, the information entered is correct. Junior knows, senior's information, so they're able to answer knowledge-based questioning. They might even have access to the cell phone to answer the SMS. So that's what we call friendly fraud. So if there is such a thing, then we ask for the lenders to feed us back not only the information on that particular loan, right? But also, if there is a customer that stops paying, let's say they have a 12-month loan, after the fourth payment, they stop paying, right? So we want to have this information. And the reason why we want to have it is because we start looking at patterns of behavior from consumers that have similar backgrounds, if you want, or their profile match. So, for instance, and I'll say something that's not true, but to give an example, if we've detected that somebody who has a Yahoo email address, who's 28 years old, leases a Toyota Camry, and lives in West Virginia, and we've seen a few of those that's next up making payment after full payments, right? So our system will actually start self-teach, or the machine learning using AI, to start flagging an application that comes that looks similar to where we've seen patterns of defaults, right? And then what will happen is that the system will automatically start creating measures to safeguard the loan, meaning that we're not going to reject the applicant, because that's not the business we're in. What we want to do is let this person in, but take additional measures in order to protect the lender. That means that we're going to ask for a cosigner. We're going to ask for a second method of payment. So if the bill is being paid through an ECH, we might ask for a credit card. So if the ECH doesn't go through, then we could charge a credit card, or we can charge a business account, or we can charge some other way to be able to repay the loan. So the system is built to not only eliminate fraud, but also optimize performance of portfolio for those lenders, right? So inside of our fraud detection system, we also have built a process behind it through machine learning and using some artificial intelligence technology to quickly determine whether an applicant falls into a pattern of negative behavior that we've seen in the past. But that's not eliminate. It's not because they're not guilty by association. It's mostly that we want to let them through, but we also want to manage the risk for our participating lenders and build additional security measures to guarantee payment.
All right, fantastic. This is a very detailed description. So, Stefan, what do you see as a future of BNPL space? Because we see also some negative reports that young people become kind of enslaved in this system. How can we balance probably innovation, risk management, and kind of social sphere in this space?
Yeah, you fall exactly into our business model. My vision, or the vision of the company, really is that buy now pay later is here to stay. I mean, it's part of the landscape on payments, and it's become very popular online. Consumers got used to it, so they also want to have access to it in brick and mortar stores. They want to be able to qualify for credit for that specific purchase, not just put on the credit card. If you carry forward a balance on your credit card, you might have bought a tuna sandwich for lunch, and you also bought a television. And if you can't pay the full amount at the end of the month, you're going to start accumulating interest, and you don't know what you're paying interest on. Are you paying on the TV or are you paying on the sandwich? The sandwich might be digested a long time ago, but you're still paying for that sandwich carrying forward on your credit card. So people enjoy the buy now pay later process because it's a specific loan for a specific product. They know when they buy it, they know when they finish paying for it, right? So it really isolate that purchase and the interest being paid on it. And I'm not even I don't want to start talking about the 0% offers, but that's a different subject. What happened now is that when a young person goes and use buy now pay later, they might get too many of these things, too many of these loans, and they get overwhelmed by the amount of payments they need to make. What WeGetFinancing does is that by having a multitude of lenders, the first thing that we do is determine who is this applicant. So from an identity verification and from a fraud or detection standpoint, but we'll also determine the quality of the applicant and look at the debt to income ratio. How much debt are they really carrying and what's the income, right? And based on that, we determine what's the ability for them to repay a certain amount per month. So when we actually refer that loan, that application to a lender, we know what the lender is able to, what is the risk tolerance. If we present an application to a lender and say, this person has a 70-30 debt to income ratio, this is how much they earn, this is how much is left on the income that's disposable for debt services, will you, lender, make an offer to that customer? And if that's the amount that you are comfortable lending, this is what we're going to display on the screen of the applicant of what the payment will be. So the way to manage this can be the quality applicant, but also the length of the loan. If somebody can only make $112 a month in payments, and they're making a $1,500 purchase, right? And the interest rate is, let's say, 11%, right? We might need to give this customer a 24-month loan or 36-month loan. So it will be even $112 that's left over, right? We'll say, okay, let's give them an $82 monthly payment. So they have money left over, but the loan will be longer, right? And so what we try to do, or what the purpose of the business model for us is that we never want to present to a consumer a loan that they cannot afford, right? So the filtering is not only identifying the consumer and verifying that it's a legitimate purchase, but it's also presenting offers to the consumers that will fit within their ability of repayment, thereby increasing the likelihood of repayment of that loan and bettering the performance of the portfolio created for that lender. So a consumer might qualify for two or three different loans, meaning that multiple lenders in our portfolio might approve this customer, and the customer is presented with these offers, and they choose the one that makes the most sense for them. Because there's only so much we know about the consumer. Customers can have the same income, similar debt, and be the same age or the same credit score, but their circumstances are different. Somebody lives in New York or in Los Angeles, the cost of living is probably a lot more than they live somewhere in the middle, right? So it looks like the income to debt ratio is the same, but their lifestyle is different. Their obligation of repayment are different. And the consumers will know that, but there's no machine that can know that. So providing the customer with options and different repayment system or amounts, is ultimately the choice of the consumer. And if they make that choice themselves, they choose that loan, they are much more likely to live with it and buy it. If you have a single lender solution, right? So merchants work with one lender, say, oh, congratulations, you've been approved. But this is the loan. And the customer is like, I don't have another choice. If I want to make that purchase, I have to agree to that loan. I don't really like the terms. The payment might be too onerous, or it's too long. I can't afford to pay more. I would like to make it shorter. Why should I make such a long time, long commitment? Having a single lender option is not conducive to, number one, great conversion for the merchant, but also performance for the lender, right? So what we try to do is to provide the consumer with as much flexibility as possible by providing them choices, provide the merchant with this greater conversion ratio, because now more people get approved because we cover the full credit spectrum, right? Plus we give them choices. And the fact that we give them choices provides a much greater performance on the portfolio created for the lender, because the customer actually has chosen the loan that makes the most sense for them. So this technology, we are a technology company, we're not a lender, but this technology allows real banks to participate in the marketplace by connecting to the merchant through the technology that they use, provides the consumer with many choices and the ability to make the choice of what makes the most sense for them. The merchant to sell more merchandise because more people qualify, because we have banks that cover near prime, subprime, super prime, all type of credit profile. And lenders to be able to participate in the marketplace, a very good performing portfolio, and being only fed customers that match their underwriting criteria, right? And all this is happening simultaneously. It's not a waterfall. It's a predictive system where all the applications get presented at the same time, and to the lenders that qualify, and the offers come instantaneously on the customer screen, and they're the one choosing. So if you ask me what's the future of this, I think this is the future of this, meaning that you don't want a customer to be overwhelmed with it, to take too many of them. So young people might be tempted to do that, but we won't let them till we get financing, because we analyze the debt to income ratio. And it's a real win-win over. So our vision is that buy now, pay later is here to work, is here to stay, and it needs to be controlled in an environment where we are brand agnostic. We're not favoring one lender over another, right? We allow all lenders to participate through our technology, and we benefit the consumer and the merchant by providing them with more options and better conversion and more choices for the consumer. Yeah.
All right. So, Stephane, I would like to ask you a personal point of view. What are the major misconceptions in this field of BNPL credit risk management space that you kind of strongly disagree with?
Well, I think that there are companies that have positioned themselves at be all and end all, meaning that very much like they certainly raised a tremendous amount of money from venture capitalists, and they branded themselves as the pioneer in the industry. Some of them have gone public. I think Klarna is going public probably next week, I think, with a pre-money valuation of about over $15 billion. So clearly they have a footprint. They're very well embedded into the merchant community, and they brand themselves very well. We are non-brand brand. We're not looking to, and the consumers become a Klarna customer or a firm customer or a Bread customer. With us, they are the customer or the merchant. We're not, we're not branding ourselves as the lender, right? We're here only to facilitate it. I think the misconception from the merchant community is that, you cannot, the same way you need to have Visa and MasterCard, to offer to your customers, or American Express or Discover, that you have to have a firm or Klarna or one of those, right? I think that what happened is the same way the credit card industry is served, where there are clearly four major brands in credit card, being Visa, American Express, MasterCard, Discover. They all use one form, right? When you enter your credit card, you enter your credit card through one form, right? And from there, you don't have, well, do you have a Visa card or a MasterCard? And you don't have to choose which button to click on. You say, I'm paying with a credit card. And the gateway, or the processor, is the one that actually directs it to the network from which the issuing bank is affiliated.
Mm-hmm.
Buy now, pay later should have many players in the space, but it should not be a complicated process for the consumer. A merchant might say, well, Klarna might approve these people, a firm might approve that people, and they might have a multitude of buttons on their checkout page, right? So, because the merchant understands, not everybody, not one lender can accommodate everybody. But so instead of having multiple buttons and the customer doesn't know which one really is going to be the best fit for him or her, that it needs to be a single form, which is what WeGetFinancing does. We have one form, you enter your information only once, and we do the sorting on the back end exactly like a credit card gateway. So those are where I see that it's going to take a little bit of time for the retail community to catch on to it. But we are here to capture this traffic, and the technology has been built, has been proven. We're making deals every day. Like I said, we brand or vertical agnostic. Like one company might say, well, we like jewelry, but not furniture, or vice versa, right? For us, because we work with multitude of lenders, we can accommodate any vertical, any ticket size. And we always make sure that we provide the consumer with the best possible credit offer based on the credit profile. So, and no single lender can actually do that, right?
Oh, fantastic. So, Stephane, thank you. That were all my questions. Perhaps if I forgot to ask you something that is important to our audience, please go ahead.
No, I think we covered it all. You were very thorough with your questions. You asked very pointed questions, which triggered a lot of, clearly you thought about it and done a great job. So I appreciate your time and the attention to this subject. And I hope that your audience will react in kind.
Thank you. Thank you. Hope to see you and your colleagues in our show later, maybe in a few months or something.
Very good. Well, feel free to reach out.
Thank you.
Thank you very much.